So in this video, we're going to share with you how to pick your recession-proof property goldmine location. So it's so important to get your goldmine location. It is the fundamental behind what you do. But if you'd like me to live in or around London, investing in single-let properties in and around London is just a non-starter. And yes, there is the 1 hour myth you should invest within 1 hour from where you live. But let me give you a shock horror announcement. There's this magical thing called the internet, which makes anywhere local to you today. So anything you do in person can be done virtually. But before we get into picking your goldmine location, first of all, if you've not done it already, subscribe to this page. We put out content like this all the time. Hit that bell icon and let's get rolling. So there's this common thing, the 1 hour myth, and I'll tell you why the 1 hour myth didn't work for me. I won't go too deeply into this at the moment, but I was born in London. I grew up in a little village called Aveley, around probably half hour from where I was born. I live in Brentwood now, about half hour from where I was born. And I knew instinctively in 2009, when I first started investing, that Aveley was not an investment location. I didn't go into London because I didn't have the budget, so I went within an hour from where I lived to Southend-on-Sea. And it ended up being in the middle of a red light district with heroin addicts. I'm not going to go too much in this story. You've probably heard it before. Definitely check out some of my old videos. But I didn't know the area any better than I knew Stockton-on-Tees, which was my remote location area. And it got me thinking. I started investing there and I met a guy from the area. And everybody kept on asking me about it. How did you pick the area? And really it picked me because I met someone from the area. But I reversed engineered it into this process that I'm going to share with you now. And the power of your questions is the power of your results. You've got to ask yourself some fundamental questions. But that 1 hour myth is exactly that, a 1 hour myth. I've heard people say as well that find a strategy that works in your city. And again, I won't go too deep into this part. We'll try and keep it on the location. But this is your property delta matrix. The main thing that's going to make a deal work is money, knowledge, network. And in the middle of all that, you've got time. These are the main core fundamentals. But then if you want to build foundational wealth in property, you've got buy-to-lets at the bottom. You've got SAs and HMOs. You've got commercial conversions, and then you've got developments at the top. The thing is, look, if you're in London, the only stuff that really works in London is maybe some of this stuff here, and definitely more of this stuff. But this, if you've got no experience, you shouldn't be diving into this stuff. Maybe if you've got transferable skills, you can cut this matrix a little bit higher. But again, if you've only got 30k, you live in London, and you've never even done a refurb before, and you don't know how to cost that, it is dangerous going further up. Well, you're not going to be able to start anyway. Let's use other people's money. If you use other people's money when you don't know what you're doing, that is really irresponsible. So sorry for the shock horror, and I know loads of people peddle that. It's never gonna, look, I'm a coach and I'm not knocking coaches, but it sells more courses to say, how do you want to invest in property using none of your own money? Yes, you can do it. I've just raised 100k yesterday to buy a block of 6 flats. But I've got this foundation and the experience of knowledge network and money coming in to support things when they go wrong, because things do like go in different directions to what you plan. I'm not going to go too deep into that, but make sure you're in the right place for your journey. But look, if you've got 30k and you start, even if you haven't got 30k, you want to build a foundation of single let properties. Most banks want to see this anyway. I want to see you've got some experience and some foundation now. And how you pick your area on that. If you live in London, it's just going to be a non-starter because single lets don't work. In and around the south, anywhere where I live, it's a non-starter. So you've got to then pick the area. Your area where you live might be right. You might live in the northeast. You might live in the northwest. You might live in Wales. But how you make sure you make, instead of an emotional decision, an emotional decision might say, oh, stay closer because it's going to be safer. But everything you do in person can be done virtually. Like everything from viewings to sourcing, it's all online today. You've got to get yourself out of that mind shift. Everybody asks me when I'm coaching people, what is the biggest challenge from remote property investing? I said it's the mind shift and the mindset of knowing that you can do everything in the cloud. Think about it. You don't go into estate agents anymore. You go on Rightmove. You don't go and walk down the street looking for a builder. You go on Trek or Trade. So everything's online today. And look, of course, there is obvious benefits to investing locally. But if you only got 30k, 40k, or even 50k, and you live in London, it's a non-starter. So you're going to have to then take the next best option and just start doing everything in the cloud. But even if you live locally, doing stuff in the cloud and online is going to streamline what you're doing. And as I said, look, strategies do, like you might want to go to rent to rent, but if you've got to think about the strategy you're going into. If you want to be a rent to rent person, you're going to be a property manager. You might have time. I know a guy that was in London, took on a load of essays, rent to rents, got sold that dream and realised he was super busy and removed himself from what he was aiming to get in property, which was freedom. Most people get into property for financial freedom and passive income, and you won't do that from rent to rent. I'm not knocking rent to rent, by the way, but if your aim is to do that, properties get rich pretty slowly by building wealth and assets, but it compounds over time and gives you a fantastic return. So really, really think about the strategies. These sort of strategies, rent to rents or HMOs, commercial conversions, are when you're further up in the journey. There is odd exceptions. There is people that can jump up quicker, but I advise you to start with vanilla buy-to-lets, cut your teeth and get a good foundation. This is the stuff that protects you from the downside. So again, if you want to go to a recession and you're doing a commercial conversion, the bank can pull back the money. If you've got some HMOs and people, and luxury ones, people don't even want their en-suites anymore because their cost of living's gone up or their job's been reduced or their hours been reduced. But family buy-to-lets is where your bread and butter is. It's vanilla, it's boring, but it is the foundation of any really strong property portfolio. So I really encourage you to do that. So how you pick your location anyway, we've got this exercise. So there's major questions. As I said, the power of the questions are the power of your results. So first of all, you've got to think about location. You've then got to think about price. You've then got to think about network. You've then got to think about your forced appreciation, then capital appreciation, then return on capital employed, and then your rent demand. Let's put RD. So make a sheet of these. Listen, when I coach people, they pay me £2,000 to coach them. This is the core fundamental exercise I take them through. So pretend that you paid me 2K and go through this exercise and take the emotions out of your decisions. Don't just stay in your comfort zone because it's a bit closer, but realistically you can't even afford it. But then what you want to do is take this into a chart, each areas, and then score these. So if you then, look, I'll score my area, for example, I'm in Stockton-on-Tees, and let's score where I live, Brentwood. So location, which means how far away is that? For me in Stockton-on-Tees, that is a 1 because it's 4 hours away. In Brentwood, that's a 5. So score these out of 5, 5 being the best score. Then I'll go price-wise. 1 in Brentwood because purchase a flat around here locally is 350k and I'm going to rent it for £1,100. In Stockton-on-Tees, we just had an offer etc today for a 4-bedroom for 72k. So price wise suits my budget. You might have £1 million, so London might work for you, you know, and you might be able to throw the money out to go further up. But price wise for me is a 5. Then network. I don't know any builders or anybody really locally, even though I grew up around here. All my friends that are builders, yeah, I don't never use them when I'm going to do projects. We just change my bathroom into an ensuite into a bedroom, or half of it into a bedroom. We had a ginormous ensuite, and I didn't use anybody I knew. I just went and got trades of a Trekker trade and rated people. The same thing I do if I'm up north. So network locally is a 1. I've got none. I don't know no other investors or anything, but network up there, I had a 5 because I knew that guy from the area. This is the key, meeting somebody. And it's not, I met this guy by random chance. He moved down from the north and he met a girl I knew, and he's done over 100 deals in the area. He's got several businesses, but that was a random chance. But today, the chances do not have to be random. Go into my remote property investing community and say to people, look, I'm coming to Middlesbrough to invest in properties. Anybody wants to connect with me? I'm coming to Newcastle. You get people hold their hands up. You can just find these people online. This is the game changer for investing for anywhere today. So next one is forced appreciation. So what I mean by forced appreciation and capital appreciation is the time it goes up over a period of time, and forced appreciation is when you BRR it, you buy it and you force the value up by adding value to it, adding rooms, doing refurbs. So forced appreciation, more forced appreciation you get, usually less capital appreciation you get, because the more capital, the main reason you get forced appreciation is from motivated sellers. And you've got to think about it, usually takes about 8 to 10 weeks to get a property sold, property sold, and then it takes another 8 to 10 weeks going legals on an average market. In a hot market, it takes a few days. So for me to make BRR work, I want a 15% discount on the property to make the numbers work. At least 10% in today's market because it's a bit hot. I've moved my expectations a little bit. But if you've got a hot market, somebody can advertise that for 3-4% with a discount, and it sells within a day. So the main reason you get false appreciation from motivated sellers, if they've got to wait 8 to 10 weeks just for a potential sale, not a definite sale, then another 8 to 10 weeks in legals, they're going to think to themselves, if you turn up and say, look, we can buy this and get this through legals in 3 weeks, we've got the right solicitors, we can move, we've got no chain. That's enough of a value exchange for them to think to themselves, okay, let me sell this property to you for a bit cheaper. And that's where you get motivated sellers, and you add the value to it. I always get asked this, so if I bought a property for 300k locally and it went up 10% per year, which it hasn't been doing, by the way. Most of the growth is in the north because the price per earnings ratio, that's for a different video. But let's say it was going up 10% per year. That's a 90k growth in 3 years. It's going to cost me about 100k to buy the property, and I'm not going to be able to BRR it. If I bought the same property, spent the same 100k in the north, I would be able to buy 4 or 5 properties. They had 20 to 25k's worth of equity to each one of them properties. So then I'd have about 100k's worth of equity, 10k more than I waited for 3 years. And I could probably do that in a 6-month period if we're not in charge of a hot market. A bit more challenging in today's market to do that. But this is why I like false appreciation. So when I went to my area, the capital appreciation for Stockton for me was a 1. There was none up until 2 years ago. Now we've had about 20% in the last 2 years, and it's switched around. The false appreciation is lower. But the false appreciation was a 5. There was a lot of motivated sellers. We was buying the first 3 deals I've done. I got my first deal I done remotely. I got all my money out and 2k on top. The next one I left about 3k in, and loads of these deals. There's loads more motivated sellers. If I was doing that locally, false appreciation is a 1. There's not so many motivated sellers in the area I am. Capital appreciation is not that high now, but back then when I started, it was definitely higher. Probably more like a 4. So then you've got to look at your return on capital employed. So if I put 100k in to get a 3% return locally, I could put 100k into properties up north and get myself a 40% return on capital. So in the north, this was a 5. Locally, that again is more like a 2. It's a really low return on your capital. And then rent demand. So there's microeconomics in each area. So you've got to make sure you find the micro parts of each area. So once you've picked an overall area, so you pick Stockton-on-Tees, you don't invest in every part of Stockton-on-Tees. Very much like my first property in the South End, there's going to be parts where there's prostitution, alcoholism, drugs, social violence and social issues. So you've got to get the micro pockets in these areas. So once you pick the overall area, it's about drilling down, and there's different micro pockets, different micro statistics, what you can get from these areas as well. Like there's different postcodes that have different capital appreciation, but the average might alter that. So I was in Middlesbrough last week, and it's voted as, it's come up on statistics as one of the most dangerous places in North Yorkshire. But yet there's loads of nice pockets there. So if you looked at it as a whole, you'd think it's all dangerous, but there's loads of good bits. You've got to get the macros and micros. How you go further into getting the macros and micros is a software called Landlord. I'm going to show you a little bit of this in a minute, but Landlord is a great software. You can do analytics and the long-term growth. You can plug the figures in. It's absolutely free. I've been using this myself. I'm working with them at the moment. I've just tested it out on one of my smaller portfolios because I've got portfolios in different companies. I'll show that in a minute, and it's fantastic to track everything. It can even give you mortgage offers, and it's a digital broker. So check that out. The links below for Landlord. It's a fantastic software, and you can go deeper into the analytics of the area, but you've got to qualify and disqualify that area first before you go deeper with the analytics. And then you've got to think about the rent demand. What is the rent demand in the area? Like, basically, you don't want it, if it's a top rent demand, it often eats into your return on capital and your yield. So you've got to get that sweet spot. But between about 3.5 and 4.5 demand is where you're going to get the better returns. If you go 5, there's going to be too low on returns. So mine was about 3.5, depending on the microeconomic points I was investing in. But around here, it would be more like the rent demand is more like a 4 because the affordability it's into there. So then what you do is you score each of these up. So let's use a calculator to help my head here. So this one's 24.5. So this scores a 20, but the highest scorer does not always mean it's the best one. You've got to have trade-offs. So for the longer drive, is it worth a trade-off for the more false appreciation? And you've got to ask yourself these questions. You might have loads of money coming in and you're not worried about BRRs. You just want to park it into an area that's got high capital appreciation, and it's a pension scheme. You're not touching the money. So it's a very different strategy from somebody that wants to build this into a business. So you've got to figure out where you want to go and what your end goal is with that first. But as promised, let's jump over to the laptop, quickly show you Landlord. As I said, the link below for this is in there. It's a fantastic software, so I really encourage you to have a play around with it. It's absolutely free as well, so there's no sales on there. I think there is a paid version if you want to link it to your bank account and the zeros and things like that, which is very low. But it's a free version, really utilises free software. You can analyse deals, you can analyse area growth, and you can start plugging in the details of these into this. So as I said, I'm super impressed with this software. So once you've put your macro and your micro areas, you've worked out the macro and the micros of the area, and you've got your micro spots, start putting it in there. Look, the great thing is as well, if you've got a portfolio as well,
I've tested this out on a portfolio of 6 properties we've got, and look, you just put loan to value, how much money you got in there, how much you earned, you do P&Ls for individual properties. It's great, but that's not the section I'm going to show you at the moment. There's loads you can show on there. We're slowly putting all my properties in there. We've got a decent sized portfolio, so I'm putting other ones into there now. But look, if you go into there and you want to look at an area, so we looked at this for the Fontaine Brothers. Go and check out their content earlier on. If they was wanting to look at the macros of this area, you plug in the area, you plug in underneath here the purchase price, the value. This is a deal they just done. I coached the Fontaine Brothers, and they've just done this deal. They bought it for 60k. They refurbed it for 30k. I think all their cost in it was around 4.5k costs. And they've got 4.5k out on top. They've refinanced it now. They've got it valued. But the great thing with this is it tells you the return on your capital employed, the actual capital you got in there before refinance. It tells you what the yield is. It also tells you long-term statistics on there. So it tells you what the long-term is over the next 10 years. And you can edit this to 5 years, 10 years. It really goes deeper on the micro areas. And you can see the history and the predicted future of these to make a more educated, informed decision on your investments.
So as I said, link for Landlord is below. Thank you very much for jumping on here. Please put in the comments what area you've picked. If you go over your own area, if you've already got one, to see if this works. But remember, anything you can do in person can be done virtually. My wife's to live on my own terms. My mission is to help as many people live on their own terms, using property as a vehicle or education or mindset to do that. So please share this out. Let's get this message out there. Let's get people living on their terms. And if you've not already done it already, hit that subscribe button, hit that bell icon so you get notified when we release videos like this. Please share this out. And remember, if you don't evolve your ideas, you'll never live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day.